After the US stock market had a pretty terrible year in 2022, with the Nasdaq down 33% and the S&P 500 returning a negative 18%, investor sentiment has seemingly become more and more bullish again, despite the continued hikes in US interest rates that are now sitting at 5.5%. And this new bullishness is reflected by the valuations of US stocks. One chart recently went viral on Twitter, showing that 100 of the largest stocks in the largest stock market in the world, the US, are now priced at around 10 times the revenue. So are we in for another stock market bubble? And what exactly does all of this mean for investors? This is what we're going to discuss in this video. So without further ado, let's get started. Alright, so I've once again prepared a little presentation that I want to go through with you today. So first of all, what can we see here? Basically, we can see three different charts. In the light blue, you can basically see the price to sales ratio of the entire S&P 500 index. Then in dark blue, you can see the most expensively valued stocks of the S&P 500 measured by price to sales. And then in light gray, we can basically see the cheapest quintile. Now, as you can see, we are once again trading at very elevated levels. Basically, we are approaching the 10 times revenue ratio once again for the most expensive quintile of US stocks. And historically, we have rarely seen such a high valuation of the most expensive stocks. Basically, we've only reached this level of valuation in 2022 and 2021. So basically during the everything bubble. So what are some possible explanations for this elevated level of valuation? Well, I would argue there are some bullish investors who would explain the elevated price to sales ratios with higher business quality in the US stock market, because after all, not all revenue is created equal. So let me show you a couple of explanations. First of all, you could argue that today's businesses are more profitable, that they are achieving higher profitability margins. Just to give you an example, let's assume a stock is trading at 10 times sales. Quite frankly, this doesn't tell you anything about that particular business in terms of whether it is overvalued or not. Let me just give you an example. Let's assume it's a business that is extremely profitable, generating 40% free cash flow margins. This would mean that measured by free cash flow, this company would only trade at 25 times its free cash flow, which of course is not cheap, but at the same time, it's not ridiculously expensive either. On the other hand, if a company trades at 10 times its revenue, but only generates free cash flow margins of around 10%, well, then the price to free cash flow ratio would actually be 100 times the business's cash flow, which of course would be, I would say, ridiculously expensive. And in fact, there is evidence for the fact that over time, US companies have become more profitable. This is something that Michael Mauboussin has actually highlighted. He showed that over time, the operating profit margin of businesses has gone up. Now, another explanation could be that today's businesses are stronger, of higher quality and more competitively advantaged than maybe US stocks were in the past. Of course, higher quality and stronger moats would demand or justify higher valuations. So that is maybe an alternative explanation bullish investors could come up with. At the same time, stronger moats and stronger competitive advantages would also lead to higher visibility and predictability of businesses, which is always rewarded by US stock markets. I shouldn't say US stock markets as a whole and investors. Basically, stock market participants on average really hate uncertainty and reward certainty, which of course means visibility and predictability. Then another aspect to consider is recurring revenue. Of course, stocks or businesses that are to a large extent generating recurring revenues are much more predictable, which again will be rewarded by stock markets, which in turn could explain higher price to sales valuation multiples. And then finally, one also needs to consider growth. I don't have any exact data on that, to be fair, But you could argue that if businesses are growing at a faster rate, this would justify higher price to sales ratios. And then one last aspect that I noted down here is that in today's world that is much more digital and much more global, many businesses might have more options. They can expand their existing business or businesses to new markets, new business areas, which would of course increase their total addressable market, so their TAM. Overall, you could also argue that due to the digital nature of many businesses, they are less capital intensive, which makes them arguably less risky, which again could justify higher valuation multiples. However, to be fair, that is not my perception. I would argue things are actually much more simple. Okay, before we get into the more bearish perception, let me just tell you that I'm already working with a group of people where I teach value investing principles, who I teach basically how they can implement a clear and proven investment process. And if that is something you would also be interested in, want to get mentored by me, feel free to reach out via either Instagram, Twitter, or of course you can also send me an email. You can find my email in the description box down below. Now to get back to the more bearish view, let me just show you this chart here. This chart is focusing on the price to earnings ratio, so not the price to sales ratio, but I think the overall message is pretty much the same. Basically, higher current valuations will translate into lower expected future returns. There's nothing guaranteed in investing, but I think if we look back at the price to sales chart that I showed you at the beginning of the video, you can see that we are basically reaching a level, at least for the most expensive quintile of US stocks, that is unheard of. And that, in my view, will most definitely lead to disappointing returns going forward. In fact, I would argue that valuation and the price that you pay for businesses is all that matters. I would say there are a couple of reasons why investors may lose money in US stock markets, or I should say in stock markets all over the world. One common explanation is certainly investor behavior. So people tend to sell stocks when they are declining in price, and they tend to buy stocks when they are going up and maybe have already reached a level that is not going to yield any satisfying returns. But then on top of these psychological and behavioral biases, I think many investors are unaware of the impact of prices and valuation on their future returns. So I think people might either not be able to value businesses, they might get their valuation wrong, which will of course be a costly mistake, or they may not demand a high enough hurdle rate, so high enough rate of return, which put differently means they are not buying cheap enough. And I think if you would invest into this top quintile of stocks measured by their price to sales valuation ratio, you're definitely not demanding a high enough rate of return, because I can almost guarantee you, of course I don't know, but I can almost guarantee you that this quintile going forward is not going to create spectacular returns. There are many examples for this. For example, in my more recent NVIDIA video, I outlined the case of Cisco, which as a business has developed quite favorable ever since the dot-com bubble. But then the stock was trading flat basically for more than a decade, just because the valuation was so excessive back during the dot-com bubble. In this context, let me just show you, I would call it a legendary quote from that dot-com era. It's from the co-founder of Sun Microsystems, which used to be a stock that was publicly traded back then. And he said, I'm just going to read it to you, "At 10 times revenue, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes you pay no taxes on your dividends, which is kind of illegal. And that assumes with zero research and development for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at $64 a share? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking?" Now, sometimes people are criticized for sharing this particular quote because It doesn't take into account growth, but I think the overall message is something I would fully agree with. Basically, the authors of the graph that I'm discussing here. So that's, I'm sure I'm going to mess up the name here, Kailash Capital Research. They have concluded, quote unquote, the data is so extreme that we just need to sit back and let economic gravity do its thing. And what they are referring to is that over time we are going to experience mean reversion. The price to sales ratio of the top quintile of US stocks is definitely going to come back down to earth. It's going to come back down to a more normal level. And then, of course, investors are going to have to face and overcome the multiple compression headwind. Yeah, and let me wrap it up with a tweet from a fellow friend of mine from Twitter, Andy. He's usually tweeting in German, but I've included the translation. So he would want to bet with you that this quintile of the most expensive US stocks is not even going to outperform US bonds over the next 10 years. And personally, I would not want to bet against him. Let me know what you would do. Yeah, and with that, we'll wrap it up here. Take care.